All right, guys, we're into the second, midway through the first month of 2016. It's January 19th, and we've got, as you guys know, a lot of volatility that we opened the year with. China is behind it. Fed interest rates and their decisions come with each meeting. They're continuing to back out the next rate hike because they hate to hike it. What's interesting is the Fed isn't as concerned with the market volatility in January like they were back in August when China was the reason for it. That's interesting because, and that's good because volatility is more likely to be here to stay. And we're trying to reconsolidate and find value. We're in the 1800 handle as of today's meeting, and it's pretty bearish. There's some really good fundamental headwinds that could keep us bearish and two-sided to lower for an indefinite amount of time. That's good for shorter time frame traders, and I don't mean really short time frame guys like scalpers, but any kind of day trading that you look at. It's also good on a higher time frame to get in and out of positions you have when you're long stocks to know when to cover, take profit, and get back in because you see your 401k from quarter to quarter take huge swings. And I think more and more people are starting to take control of their finances than ever before. The big investment banks have always sold people on, let me take care of your money. I'll take the emotion out. I know what we're doing. Some guys do, but a lot don't. And I think that came and surfaced through the financial crisis in 07 and 08. That movie, The Big Short, I think gets people to start asking the question, do I trust these guys? Now, I'm not saying you shouldn't trust them, but you should ask the question, should I trust these guys that manage your money? Because you work your whole life to save, right? And nobody's going to care more about your money than you. And yet people trust these financial advisors a lot more than some should be. Some are great, don't get me wrong. But some are about themselves and don't manage risk even though they're supposed to be. Either way, I don't want to get off track. I just want people understanding more and more people are trying to manage their own finances. And with that and the confluence of access to these markets with electronic trading being around for now 15, almost 20 years, access is so front and center that there's a lot of retail guys and girls opening up accounts and don't educate themselves. And so I think this is continuing to be a good time to have access and know what you're doing. You just got to keep working on it. Now, as I was swinging through, I just happened to look over quickly a lot of the titles that we've had from previous sessions throughout last year. And I just quickly thought to myself, man, you should do like one super session tying it all together. And then I said, well, wait a second. That could help some people. But everybody's so different that there's different things, different charts, different ways to look at the same thing that's going to make it click for you. Let me say that again. There's different ways to look at the same thing that's going to make it click for you that maybe didn't make it click for you with something else, and so on. So that's what you got to stay focused on. We're going to talk about the new chart that George and I introduced a couple weeks ago that could help people identify areas, and I just thought of it as station to station. Market moves, stops, moves, and stops, just like a train. Where are the stations? And those stations are consolidation. So let's jump into this, and I want to go first to a sketch pad. Then I'm going to bring George in to also maybe share a screen and talk a little bit about this as well. Let's go to a sketch pad and just say, when we talk about a consolidation, it's simply where the market is taking a breath, okay? It moves down and then it chops sideways, right? It's taking a breath, a breather. It's getting people back implementing their opinions, okay? It's like the game starts right here, and we don't know where the game's going to end or who's going to have the lead, but the game starts here. The other game from up here to down here is over. Bears won it. Bears won that game. The next game starts at the beginning of consolidation. You're not going to be able to know when a consolidation begins, but you're going to start identifying it as it's happening, right? So the game begins at a new consolidation. You got to be good at identifying the top and the bottom of that consolidation, not to play a breakout always and be a momentum trader, but to see who has a chance of winning or where they're going to win, where they're going to get worried, and so on. But also to get an understanding of where the bodies are buried after the losers lose. What do I mean by that? So the Bulls will win if it does this through the top of consolidation, right? The short-term Bulls and anyone long is winning, right? Spot market's going up, it broke out. The bodies are buried down here in the previous consolidation. Two kinds of bodies. The ones that were short and are dead. The ones that are short and still short, they're alive, but they're suffering. The dead ones, they like to get a reprieve, right? They like to say, well, it didn't work the first time. I'm going to try it again. That's how your mind just plays tricks on you. All right, you lost money doing it the first time. Do it again. You'll feel so much better about taking the same trade, same opinion, making money on it. Because not only could you get your money back, but you could be right. And that's what the mind wants to do. The mind doesn't want to make money. The mind wants to be right. So there's dead bodies there. Plus there's shorts that are still buyers that are trying to get out because they just took a lot of pain, right? So that's why it's important to know where that consolidation not only was, what it means on understanding context in a magnet to bring us back there, and maybe as a launching pad to keep us from going through there in this example. Also, information that if we zipped through some good consolidation, previous consolidation, that's pretty bearish pretty quickly. All right. The better you are, and by the way, my alert levels are not based on consolidation. However, there's a lot of overlap between where I think stock traders are and where these consolidation and congestion points are, where these tighter ranges are. So it's really important to know these targets and follow it station by station as if you are following the train and knowing where it's going to stop and go back to. All right? Or the guy's going to run from first to second, second to third, third to home in baseball. You know where he's going to go. You have an idea, right? So that's the whole point, and that's what I want people to start doing is draw physical or mental rectangles around consolidation. Now, if you don't have a good periodicity, your consolidations could be useless, or they could be, they don't really matter that much. They're useless and they're jagged or whatever, right? So you want a decent periodicity, and I think the 6P&F on a bar chart, making it white against a black background, has helped, and I'm going to go to a chart in a second, has helped identify some of these consolidations for the time frames that most of us care about. Whether you trade our time frame or not, you should care about it. So you understand this, right? Why this is the beginning. Let's get rid of this. Why the beginning of consolidation is the beginning of the game, in a sense. And you start to identify who's got the lead, who's wrong, and where. I think that's a good way to understand consolidation. It's the beginning of the game. Now, there are ways to create high probability moments to kind of assume when consolidation is going to start, right? We get that sometimes where we're like, it's going to get choppy in here because we got to restick the longs, restick the shorts. Right now, this market's starting to touch and go through its regular trading session low finally. Couldn't get through 88, that level, and eventually made its way through some other consolidation. Let's take a look at the chart in a second. So that's a good way to start looking at it. The beginning of consolidation is the beginning of the game. Another way is that you look at consolidation when you draw a box and there's two openings. There's one opening at the top and there's one opening at the bottom. So the market's going to bang around that box and then zip through one of the openings. So keep drawing those rectangles in those boxes and to give you a better line in the sand moment as you go through it. If I were to draw, and this is just an illustration on the charts I'm going to show you, but if I was to draw consolidation, move, comes up in here, comes down, goes through it, goes to here, maybe consolidates, goes up, and this is what the chart looked like. These are moments now that I want to start paying attention. This one doesn't mean as much because it's already been played out. This one does, kind of, because, it worked once and then they come back to it and they chop around, right? This one means a lot. This will probably overhead resistance to go into, and maybe they need to get through it to have the longer term bears sweat. If they don't, that's a target. If they don't, the bears aren't as nervous. So if you're a longer time frame trader, you could use this to say, if I'm bullish, I need to get it through there. Or if I'm bearish, I'm not going to be if it gets through there. And you start looking at it that way. So we're going to look for these splatters on a chart. Let's go to a chart that you guys are familiar to looking at in the room. You guys should see my charts, and you do. Let's go back here a second, get rid of this pen, center this up a little bit, and say, what have we seen since I closed the trading room? I said I'd shave my head if it got through 87, 88. Hold on, let's go to a yellow pen. Even though it did by a couple ticks, that's not enough. It didn't in here, curled over, couldn't in there, curled over. Little head fake transitional moment, came right back to the thin spot. And when it got through this bottom, these two bottoms here, this bottom, it was gone. Or it was sideways to lower. Now, this now just becomes a bunch of numbers and everything else. There was a transitional moment here. There was another one here. There's another one, this down bar right here, this guy right there. Another long up-down transitional moment to keep the bears in control. They needed to get it through there. They couldn't. Now, let's take a look at the station chart. This white. First of all, the previous chart, the footprint is a 4 PNF. This one we made a 6 PNF to help show these consolidations a little bit better. All right. If you take and you squeeze the chart together, you see where it gets kind of splattered white. That's consolidation. That's congestion. So what does it mean? Let's open it up just to show, why those 89s, 88s were important. Because it was this congestion right in here. It was the middle of it. It needed to get through there in order to have a chance to get through there. But it needed, if it didn't and it curled back over in real time, you knew that the longer term bears weren't that nervous. The hourly bears, the longer term shorts, they weren't that nervous. How many times are they going to go through this to this swing low, this swing low, this swing low without doing this? This is as bearish as could be, meaning as we're coming down into here. They weren't going to hold this time like they did this time off of here. They held it that time. They weren't going to hold it that time. Yeah, they chopped, went sideways a little bit, but they just released. Shouldn't surprise you. They're taking out Friday's close, and where are they going? I could see them going to the middle of this, around 70 even. This consolidation box right in here. See that rectangle with the yellow pen? You see the chop? Bulls won right in there and took off. Now, here's the other thing. This market, when it ran up, it was going to target the middle of here, and it did. You see how it held and went up into there? Got through it. Then it was going to target the middle of this. And it does. It chops around it. It gets through it. Now it's looking for what? The bulls want to get it through this consolidation chop. If they don't, these are the two kind of helicopter lines in the sand. Guys, if they can't get it through 8081, this is the other side of 8081 down here, around 70. We're right in the middle of kind of both. Now, there might be some information before we go up to 8081 or down to 70, meaning this could be an important line in the sand because there's a game that started there. You can look at all these as games within the games. And that's how you start overlapping time frames. I think that's important to understand. You look at this as games within a game, and that's how you overlap time frames. Talked, I think last week, was it last week? When you're able to take I think you're in a zone when you're able to take a time frame that's short and that's medium and that's long, and where they overlap is your zone. You're in a zone. You're really feeling it. And I don't think you need three. I think if you could take a couple and you could overlap a couple time frames, I think this, if you're in that middle, if you're really getting a good feel for the market, it's because you're good at multiple time frames. It doesn't have to be 12 time frames or 10 time frames, a couple, right? You've overlapped a couple time frames and you're feeling good. You're feeling like you're trading well, predicting well, executing well, exiting well, waiting, being patient. Usually good trading always preceded by patience. So that's the spot, like station to station. Don't aggravate yourself too much in trying to draw these rectangles. They gotta make sense. They gotta be like, when I tighten this up, you gotta look at this and say, like George did, they had a pretty decent consolidation if you just take these lows in here and draw them up to these highs in there. My pen color doesn't stay, or the pen markings don't stay in there because it's a live chart. But you could see why you would put a rectangle around all of this mess. And that was what? Friday's range, essentially. So in the middle of it is the reason why they held it there. They held it there. And they held it there. We're not going to hold it, forever. And now they probably need to hold those swing lows as resistance. So before 80, you probably got 76, 77 that these guys will hold it. That's why we consolidated around there. Again, they want to go into this consolidation or maybe this consolidation, somewhere in the middle of here, which brings me to about 70 even. This has got to get you to understand the market maybe a little bit better than previous to this. Again, it's not, if you guys have been around us for any period of time, we're not adding new concepts. We're giving you better ways to look at the same thing. Different periodicities, different looks, to just get a sense of, in this case, not only where could it go, but where could it stop, and what does it have to do to get confident on your long trade or short trade, or to get you long or get you short, and get yourself in the zone. George, do you want to share a screen and add some things to the the charts and the way you look at it? George said he popped in.
Yeah, I'm here. Can you hear me?
Yeah, I hear you.
All right. Yeah, I mean, I'll throw a whole formula in, kind of.
All right, let me make you presenter and you could share your screen.
All right. Let's go with this. Well, I got the white 6 PNF chart, and the that right there is pretty much, you know, which was a potential, you know, target area with the concept of a market's all is trying to find where it could find the most amount of business. You know, it goes from consolidation to consolidation. You know, the bears were kind of having their way all throughout here, and then this move higher really caught some bears by surprise, and potentially you had more bears from up here that wanted to lock in some profit in here. But for the time being, on this way down, something sparked in here and you ran out of sellers. So all of a sudden there's a wave of buying that brought it up here, and then they battled again, and then you brought in some new sellers. I mean, that constantly should be going through your head. I don't know if you guys understand what I'm trying to say. And kind of the theme of the year has been, find good consolidations to be able to beat on. And that's primarily why we've been really trending lower all year. And I think it's been like the worst start to a year in 100 years. So you can't discount that happening and think that you're going to find levels where you might shake out a little bit and then go screaming higher, And then if you use it in conjunction with the rest of the markets, your ancillary markets and maybe some other price levels. I wanted to update you guys. I switched to 1500 delta for POCs. Because I wasn't getting. Well, I mean, you get information from this too. But I don't know. It's been volatile enough. I switched it. It's been working, giving me a good look. That's another thing is, you want to be able to find good looks. But for the time being, what I'm focused in on is this crude oil is not, it's not down here. It's up, in here. And that could be keeping the S&P from grouching, like going lower. But what I'm trying to show is that it's kind of a combination of everything, and the concepts of market consolidating and breaking out is consolidating and then trying to find somewhere else where it'll find some willing buyers and sellers when one side isn't overwhelmed is the reality of how a market works, and that's constantly going. And I think, a chart like this really, really maps it out. And you have to understand the idea of, what it is, And the reason a market exists is to facilitate trade. So.
One thing you want to make sure, as I'm listening to George, you don't want a consolidation that's too close to like it just happened. And then you don't want one that's already been kind of grazed over. So you want like a virgin consolidation, we could call it, is key. We went through like a small prior consolidation just now as I handed it over to George, and that got it bullish. Like it didn't hold there. And if it didn't hold there, the next 3 or 4 points up were possible. And if and it was going to go to those 80s like it has, but that tiny one, right? Yeah. A little, yeah. Right above there, though, right above like, well, the middle of the consolidation we were in, but there was a little tiny one above it that was around 76 half, the middle of it. So you draw a line through 76 half down a little bit. 76 half. There you go. That little consolidation, it's like a little golf club. You know, as soon as we nose through there, there's a chance that the Bulls could shake out the Bears and win that game.
Well, I mean, let me throw in here, right here, real time. If I do this, you can see it better. But I mean, what is this right here? This POC? Well, it's smack dab the middle of here.
Yeah.
You know what I'm saying? So that's why you have like, for whatever reason you kind of caught this transition going higher. You kind of know what you're looking for your upside. And then if you decrease your expectations but trade more often, I feel that's how you take advantage of volatility. I think
that's why we like volatility, is because it gives you the opportunity to trade more often because there's more opportunities to trade. Just
right.
More movement, more opportunity. More opportunity to lose money if you don't know what you're doing. More opportunity to make money if you can value a market correctly and accurately and manage your risk. The moment that's going to get, I think, be the ultimate clickable moment for someone is executing inside an area that isn't random to you anymore. So now that these consolidations and the way to show them on a 6P&F, they're not easily identified by your competition. They are as they go later on and everything, but they're not, people don't know what to do with them, and they don't know what it means when they don't work. See, if they worked all the time, eventually then they wouldn't. Everybody would play them. But they don't know what to do with them when they don't work, so they go back to the drawing board. Well, what to do with them when they don't work is to change your bias, at least temporarily. The point I'm trying to get to is the ultimate light bulb click moment that people are going to have. Some have had it, some are close to having it, some will have it, is identifying the areas that you want to trade, and you're actually trading them and you're making money. And you feel like now you could build on it because it's not random. You got to notice something different in an area that you didn't notice before. Could be a correlated market. So someone had asked me that was their issue. They feel like they've got the areas, they got the I don't want to say tempo, but they've got areas down. They understand it. It's just that trigger moment. I think that's the last moment that you're at to finally have these things click for you. And I would think that it's a correlated market that could kick your rear end into trades. But you got to be looking at them the right way. The way I think it helps people the most is to watch them price ladder next to price ladder. But I want to bring Carl into this, not to talk, but just to type. He's been having a lot of success this year and has had a spike in his success based on that notion. Carl, do you watch them side by side by side? He says watch what? When you're trading. Is it fair to say that your success has come from tying a market next to another market? Yes or no? And so if that's the case, and it is, how are you watching these correlations? And he types in, he's watching 6 domes plus the charts. So he's got, hell yes was his answer to, is it fair to say the correlations have led to his success or his turn the corner moments? So it's not just watching other markets, how you're using other market. It's not always the same market every day. So there are some moments that a market will create and execute for you, meaning you weren't in an area, but there was just a big move and it made you get long or get short because you identified where the other guys are wrong. I don't want people to get all excited and anxious when it gets into the quote area that you want to trade. That's never the point. Never was the point. I don't want people to get excited. All right, ready to go. Let's watch. Let's watch. Ready, aim, fire. Fine. But every moment in a chart along and up and down a dome is a tradable moment. Now, you might not want to trade every one of the tradable moments. But if you put too much emphasis on an area, the area, you're going to get too tight and anxious and nervous when it gets into there. You know, it's like the in a movie when the music picks up, you know, and there's a chase on and all that stuff. Keep the dramatics to Hollywood and don't sensationalize it too much. Have good areas, but don't get so tied up into you have to trade that area. I have to look for this. You have to look for that. You do want an expectation of what am I going to look for to get long or get short, and what do I need to do to get out? Where am I wrong if I get in? Where am I right? What do I want to see? I'd like to see this, that, and the other thing happen. And then also, I would like to see the market go my way pretty quickly. Right now, we travel just north the middle of this consolidation, which is 80, what is it, 81?
Yeah.
And then come right back through it and got bearish, long up, down bar. I'm looking at George's chart.
Yeah, let me give some people another look. You guys see, if you understand what's going on, you know, it's very, very helpful. Well, right here, you traded up to this one and attempted to pull back. You locked in too many shorts right here, and the market wouldn't pop lower for them. And so they started to cover. You run into here. You know, this is a POC also. And then you had some waiting sellers. You know, they're waiting up here. I'm making them circles right now. And so you got a wave of selling when you reach this level, right? And now they knocked it back down. But these couple ticks right here could have been a little bit of a shakeout, which doesn't make it look exact. But, you know, that's tradable stuff. You know what I mean? I mean, and if you lower your expectations per trade, you know, try not to hit the, you know, the real big move, because, you know, if you're always constantly trying to hit the real big move, you're going to let, like, you know, profitable trades turn into scratches and small losers. And, you know, that's what volatility creates, is a lot of opportunity. I mean, just in this little mess, the time that we're talking, you know, if you lowered your expectations a little bit, you know, there's a million different tradable moments, even if you're a buyer or a seller. Well, you know, if I was a buyer and I'm like, well, you know, if you break above here, you're potentially going to run to here. Well, you pull back and you come shooting through, and then, you know, here's your trade, 79.5 to 81. You know, what's wrong with that? Anything? You know, and then well, you didn't go for the 10 points, now you're back on the sidelines. Well, you're like, well, we had this head fake, we got less shorts. Well, what if I sell it against the 78 quarter now, because, you know, you're breaking out of this consolidation, right? And then let's look at the 6 PNF and see what that looks like. You know, we're looking for recognizable, tradable structures. And yeah, here you go. You can kind of see what's happening here. But somewhere in here you got to have some kind of opinion, and then, well, let's match it up with another thing that tends to happen a lot, and that's attempt to get to these extensions. Well, it's volatile, so give yourself an 8-tick window. The actual extension is 69, so somewhere around 71 to 69 is the potential downside level that it's trying to trade to. And then figure out your risk reward, compared to the structure that you're trading.
You got to be able to articulate the trade you're looking to make before, but then after you get into it. What are you looking to do? Talk those things out. Team Room was helpful for that. But Carl mentions, again, this is well said, you have to look at other markets for guidance. And he says he tries to find if there's a market that the ES is following. Sometimes it's Apple or the euro or the yen or oil. He'll pay more attention to that. And lately, the last couple sessions, it's been the bonds. You could see a big rally in the bond right now in the mid 159 handle, and it's keeping pressure on us. So we're going to hesitate around 75, but then it seems like we're going to rotate and try to get that lower extension.
Yeah. Well, I mean, what had to cooperate a bit to get it to go down? I mean, let me show you the comparison. All right. This will be kind of cool for you guys to see, and this is how you really should compare and contrast markets. This is the S&P. This is the NASDAQ right here. I mean, the NASDAQ, look, this is the earlier low on the NASDAQ. This is where we're at. This is the earlier low on the S&P. This is where we're at. And, well, how come the S&P isn't quite as low compared to the earlier low? And this is probably your answer. I'll put an equal sign, and that's the crude oil. See, because look at where the low is in the crude oil. And crude oil matters more to the S&P because of the energy sector of it. So right here, comparing and contrasting, well, you're comfortable short S&Ps if the NASDAQ's going down, but you get a little bit uncomfortable because the crude oil kind of made this move lower and kind of stopped. And you can see it kind of getting stable, and at the same time, the S&P trying to get a little stable. So what you want to happen, if you get a nice skip lower in the NASDAQ, it'll probably make the S&P skip lower. Right now, the leader in the weakness is the NASDAQ. Let's see if it turns out that way. See, the NASDAQ is weaker because, look, the earlier low is right here. Okay? Mm-hmm. The earlier low in the S&P is right here. It's not that much further. Like, the NASDAQ, when it bounced back up, hardly got past the earlier low. You know what I mean? But in here, the S&P, I mean, you can even compare it to the moving average. Here's the S&P. See this little section right here? Went a little bit over that moving average. This section right here didn't even go over the moving average. I mean, the actual price of the moving average doesn't matter. It's just it's the same moving average on the same chart, and one of them poked through it, the other one didn't. That's what matters. That's how you use the moving average, because that way you can compare the same to the same. I mean, you really want to get technical. Well, here's your Russell. Here's the average. I mean, this is the same exact average. This is the move back higher in the Russell. Here's the YM. The same exact, well, it kind of did more what the S&P did, right? And how can we explain, well, this stuff not doing it? Are you getting short right now? Well, flapping my mouth. Because I should be, man.
Yeah, well, like I said, it was going to hesitate at 75. It has, and it's coming out of that rotation now.
I'm like this is a very tradable move lower.
Well, and it's going to hit that extension, but if you look at a 4P&F, it rotated underneath the thin spot, 76.5. It came down. It made lows of 73.25. It's going to do a little kickback to make it tough. It's got to hold at or below 76 to keep you short. If it starts moseying through 76, 77, it's back to crappy chop. Go ahead.
All right, you guys remember the NASDAQ and the Russell compared to this actual average? Look at the crude oil. So there's your relationship. Because the S&P did that, the YM did that, but the NASDAQ and the Russell didn't. So, if you get this crude oil popping lower, you got to be a super confident short. And that potential profit window with that extension becomes more and more likely. I don't even have an S&P chart here, but we'll see. If this crude oil breaks this recent swing low, S&P will go right into the 69.71 profit window. There's your comparison. You can look at it at a dome too. On a dome.
To answer an earlier question to someone, I don't know how. When someone says they feel like they're watching relationship and not getting it, I don't know how they're watching it. But let's say they're watching it like they should and they're still not getting it. You got to look at breakoutable moments, even though that's not a word, for that ancillary market. So if the oil could go and take out sell stops and it could be leading the ES, now you have an anticipation for the leader to trade the lagger. Here's a moment of truth for shorts right now. The 75, 76 even area.
I got the oil up, and I'm keyed in on this low right here. This low on this 30-minute period. I'm just keyed on it. Let's see if the oil takes out that low. I think you really, really should get the move lower in the S&P. Let's just see how it plays out, and this is how I would compare the crude oil right now. Well, the crude oil hadn't bounced as much as the S&P did right there. We're comparing and contrasting right now. It's the middle of the day though. It's kind of slow too. So here's a little pop lower in the crude oil. So I mean, technically the S&P right now compared to the crude oil is expensive. The S&P right now is sellable comparable to the crude oil.
Yeah.
The S&P is sellable compared to the crude oil.
Should be able to pull it down. That thin spot should be able to create this curl we're getting, 77. You could have just kind of laid into that pop and see if oil stays weak. And if not, you shouldn't get killed if you're wrong.
Right.
When I say lay into that pop, we had that little move up to 77 just now, and then bam, down to 75. And if you're watching oil and understanding that relationship and what George is talking about, now it should, you want to keep oil through what? 30 a barrel.
Yeah, 29.96, 30 a barrel.
And oh, by the way, if anything else wants to help out, great. Russell could keep making lows. You can get a bid, a 2 or 3 tick bid in the bonds, whatever. You don't just ignore those other markets. You want to see everything happen in the direction of influence for your position. Now you want to get oil. Oil isn't that volatile. It is. I mean, it's got what? About 150 tick range?
I mean, it's leading right now. I mean, that was a tradable comparison right there.
Yeah. It popped and got expensive. ES popped and got expensive.
Compared to the crude oil, yeah.
Yeah. And that's, go ahead.
I mean, this is good stuff, guys. This is trading right here. I mean, I don't know if it's, I don't know if it's registering, but, I mean,
It's how you value something.
And then you also got the Euro stocks here. Well, the Euro stocks, it's closed and it's making new lows. You know.
Now, sometimes a trade will follow through and go right down to a target. Sometimes it doesn't. So it's like it's dictated based on what's going on. If you get too big of a jump in a Russell, you got to manage this S&P short if you're short. If the oil does what it does, you could say, well, it's maybe not going to go straight down. And you can anticipate that we just went up 6 ticks. We didn't just go
Yes.
up 6 ticks. Oil went from 96 to 02, like a 5-cent rally, and we went from 75 half then to 76 and 3/4.
But then the theme, if you lower your expectations and trade more often, well, now you're ready again, right?
Mm-hmm.
And you just profited off that little relationship.
And it has nothing to do with scalping, because you could get some powerful long-term follow-through moves off of it. Or this is the sequence you're using when you want to take a longer time frame trade.
Listen, I tell the people in the team room this one. All right, you know the quote guy you talk to on the service? You don't talk to him, but you listen to for the background noise.
Yes.
You know the one that talks about football all the time? He seems like he might be a little bit of a joker and is friends with some of the guys in the pit.
Yeah.
Okay, so I remember one time, I think it was 2006 or something, I used that service also, okay, at that time, because I found it useful. All right, at that time, but you still had a lot more volume in the pit than you do now. And one of his buddies, which was a local or acquaintances, showed him, because they write the orders down on cards. Okay, he showed him a card of, I think it was either 250 or it was anywhere from 100 to 250 big S&Ps, and it was a tick. It was a sell order, one tick below the high of the day, and on that day the S&P was like ripping lower. It was down like 45 points, or it was very volatile, and the S&P was a lot lower. And the guy said on the squawk, he's like, "There's a local here that sold." And then approximately 30 seconds after, he showed him where he covered it, and it was approximately 2 ticks lower than where he sold them. So the point I'm making is, even if it's a scalp, what's wrong with that? I mean, you had this, big pit trader that sold at 2 ticks, below or 1 tick below the high of the day, a huge position. He potentially could have made millions of dollars off of, but he covered it a little bit lower because that's what he does, and he profited it, and the money went into his account. So even even you don't necessarily have to think that a scalp is bad. There's nothing wrong with it. The reason why we're doing this is to collect. You're doing trades because you're trying to profit off of it. So if you do profit off of clicking it and even making 1 or 2 ticks, there's nothing wrong with it.
And knowing when to change your mind. But you're right. Our job is to buy it lower than we sell it. Well, let's leave it there. I think that there's buy stops above 77. Again, a lot of people watch this on recording, so with the charts and the screen share, you'll be able to stay with the relationship and why we just curled over but then ran up, because oil couldn't stay below 30, right? Just keep going with compare, contrast, station to station. And now it won't seem random. You got to get through 75 and you'll get bearish again. But, and these guys got to get it back through 80, 81 to get bullish again. Keep going, identifying the stations, and then trade the damn things when they get there. Don't look for too much, but it's most important to whatever you're looking for to get you in, you continue to see after you're in. If you got short because oil moved below 30, did it continue to move below 30? No. So whatever gets you in, you like to have it continue to do what it did to get you in. That's another important element to market relationships and watching ancillary markets. Have a good rest of the session. Team room is open. Edge at marketdelta.com if you don't have access, because if you're in this meeting, you have access to it. So give me an email if you want access to it. But few hours, this thing will be uploaded to the Track 4 portal. Remember, you guys, if you want to watch any of the recorded sessions from previous Tuesdays, Track 4 is where you're going to find it. As of January 2016. At some point in the future, obviously, it could be called a different track, but right now it's called Track 4. They'll get posted in a couple hours with today's date. Have a safe rest of the session, George. Thanks for your help. We'll see you soon.
All right, take it easy. I'll be in the team room.